Planning to own a trading card shop? You might want to think twice. Not because you shouldn't do it, it's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. If you've watched a shop owner vlog about this exact business, and there are a genuine handful of them right now, you've seen the day-to-day. What you haven't seen is the actual math underneath it, and two numbers in particular that most of that content never mentions. During the pandemic boom, resellers were reporting profit margins of 100 to 400% on trading cards. Real, documented numbers at real shops. Today, that same category of shop reports margins fluctuating around 20%. And right now, in 2026, the company most of this industry depends on to grade and authenticate valuable cards is dealing with a real backlog crisis. It spiked past 14 million cards, forced them to pause their own cheapest service tier, and is only now slowly working back down. So what does this business actually look like once the pandemic hype and the vlog highlight reel are both stripped away? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is well-researched and checked against multiple sources, but research can still contain honest mistakes, and costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific situation. This video is for educational purposes only and is not legal, tax, financial, or business advice. Always do your own research and due diligence before making any business decision. A second note, specific to this episode. Card values, grading company pricing, and turnaround times shift quickly and were current as of this video's research. Verify current numbers directly with the grading company before making any decision based on this video. The first cost, the one that's genuinely lower than most businesses on this channel, inventory, is the real capital requirement here, not equipment or build-out. This is a fundamentally inventory-driven business. No commercial kitchen, no specialized equipment, no expensive build-out. The capital goes into what's on the shelves and in the display case. Because it's such a niche profession, there's no official government data tracking average shop income the way there is for most businesses on this channel. What real shop owners have reported publicly points to a typical income around $40,000 a year for the majority. A real living, but a modest one, especially in a higher cost of living area. The product mix splits into two very different categories. Sealed product, unopened packs and boxes, carries real speculative upside, but ties up capital in something you can't partially sell. Singles, individual cards already out of their packaging, turn over faster and are where most shops make their steady, reliable margin. A typical single sale at a real shop lands somewhere around $90 to $100. It's the occasional much larger sale, a serious collector buying a specific high-value box or graded card that swings a slow week into a strong one. The hidden trap, the one sitting outside your shop entirely, inside someone else's warehouse. Your inventory's real value depends on a grading company you don't control, and that company is currently backed up for months. A huge share of this business's real profit sits in the gap between a card's raw, ungraded value and what it's worth once a third-party grading company certifies its condition. A card that's worth far more in top condition than its raw price is exactly the kind of card a shop wants to grade before selling. Right now, that grading pipeline is under real strain. PSA, the dominant grading company in this industry, paused its 4 lowest-cost service tiers in June of 2026, after the backlog spiked past 14 million cards. It's been declining since, sitting in the low teens of millions as of this video, with the company itself projecting those paused tiers might not fully reopen until sometime between November 2026 and January 2027. The cheapest tier still open runs close to $80 a card, with an estimated turnaround of 40 to 50 business days, and that's before accounting for PSA's own pattern of running past its published timelines during high-volume periods. That's real money and real time locked up in a single decision. A card worth $30 raw and $45 once graded almost never justifies that weight and that fee. The math only works when the spread between raw and graded value is large, genuinely large, not just technically positive. For a shop with real capital tied up in inventory waiting on a grading verdict that could take 2 months or more, that backlog isn't an inconvenience. It's a direct hit to how much capital can actually turn over in a given quarter. The real engine, the one that has nothing to do with grading or nostalgia, the trade-in counter, is where steady, reliable margin actually lives. So with grading now slower and pricier, where does dependable profit actually come from? The trade-in counter. Shops commonly buy cards traded in by customers at 40 to 60% of market value, with 50% widely cited as the industry standard, then resell them near full price. Run that math on a $100 card. Pay $50 to acquire it through a trade-in, sell it back out near 100, and that single card just delivered a 50% gross margin without ever touching a grading company's multi-month queue. The real advantage isn't just the spread on one card, it's volume. A customer clearing out an old collection often trades in dozens of cards in a single visit, and every one of them was acquired at that same discount, all at once, with none of the weight or expense attached to grading. That's the actual engine underneath a healthy shop. Singles turning over fast, a disciplined trade-in spread doing quiet, repeatable work in the background, and grading reserved specifically for the cards where the raw to graded spread is large enough to justify the current weight. The real money in trading cards. The pandemic boom sold everyone on a 100 to 400% margin that mostly isn't coming back. What's left, and what's still solid, is a 50% spread at the trade-in counter, repeated all day, every day, without needing a single card to spend 2 months in someone else's warehouse. A real shop that opened in Taunton, Massachusetts makes this concrete. 4 partners who'd been friends for over a decade opened a combined Pokemon and sports card shop, and one of the owners was direct about the arc of this business in his own words. During the pandemic, he described margins on eBay and at big retailers running 100 to 400%, driven by a market that had gone genuinely irrational with demand. Today, he describes that same margin fluctuating closer to 20%, tracking market price instead of pandemic mania. The shop's typical sale sits around $90 to $100. But the same reporting also captured a single customer spending $1,400 on one imported booster box in a single visit. The kind of outlier sale that can make an entire slow week. That's the honest range this business lives in. A steady $90 to $100 baseline, a 20% market-driven margin doing the real work day to day, and the occasional 4-figure sale that isn't the plan, just the upside when it happens. So let's run the 2 real outcomes. The optimistic case. You build the trade-in counter into the actual core of the business, price it disciplined and consistent, and reserve grading submissions specifically for cards with a large enough raw to graded spread to justify the current weight and cost. Inventory turns steadily through singles and trade-ins. The occasional large sealed product sale adds real upside without being load-bearing, and the business runs on a repeatable 20%-ish market margin instead of chasing pandemic-era numbers that mostly aren't there anymore. The realistic case. You lean heavily into sealed product speculation and frequent grading submissions, expecting the pandemic-era margins that got you excited about this business in the first place. Capital sits locked in a PSA queue for months at a time, sealed product doesn't move as fast as singles do, and margins land closer to that market average 20% anyway. Except now, a meaningful share of your inventory is illiquid while you wait on grading results that may not even justify the wait once they come back. Same shop, same cards, same customers walking in the door. The entire gap between those 2 outcomes comes down to whether the trade-in counter was treated as the real business or as a side activity while waiting on the next grading envelope to come back. So is it worth it? If you're picturing pandemic-era margins as the baseline, that number was always the exception, not the rule. And today's grading backlog makes chasing it even harder than it already was. What's true is that this remains an accessible, low-overhead business for someone who loves the hobby, with a real, if modest, income available to owners who run the trade-in counter with real discipline. For someone willing to treat singles and trade-ins as the actual business and grading as a selective tool rather than the whole strategy, this can be a sustainable small business built on something you already love. For someone expecting to relive 2021 margins with a warehouse full of sealed product and a grading queue as the plan, the current backlog is telling you exactly how long that plan will take to even find out if it worked. Last reminder, card values and grading company terms shift quickly. This is not financial or business advice. Verify current grading prices, turnaround times, and market values directly before acting on anything in this video. Remember this: the pack you rip is the fantasy. The trade-in counter is the business. Master the spread on the cards walking in the door, and you don't need a single one of them to spend 2 months in someone else's warehouse to make this work.